let's make a very we'll start from very basics of consolidated statement of comprehensive income. We did consolidate balance sheet, statement of financial position. So I'll start with the very basics, then I will do some short questions, MCQs, and then we will move to a full-scale long income statement. Income statement adjustments are relatively less, but sometimes these should be more complex. There are a few things which we need to remember. So let me create some example. Let's suppose that there is a parent and there is a subsidiary, okay? And I'll make some numbers here. Very simple numbers we will assume, okay? By the way, let me just yeah, I can leave it here like this. Sales and here I'm going to do group, okay? I will make group here. So I have sales, I've got cost of sales. We come down to gross profit. And then after gross profit, we have admin expenses, we have distribution expenses, and we call it profit, okay? And let's not confuse interest and taxes. Let's call it profit. We'll keep it very simple. So if I say that sales, parent has sales of, let's suppose, I don't know, 100, cost of sales are 40, and that gives me a gross profit of 60. And then admin expenses are 15, distribution expenses again 15, let's call it 10, and we make profit. This is the profit which has been shown by the parent. And then there is a subsidiary. Subsidiary has revenue, sales 60, cost of sale is 25, and then they have got distribution, admin expenses probably 10, distribution expenses 5, and their profit is 20. Now we need to consolidate, okay? So we know that consolidation is a process of adding together. Consolidation is a process of adding together. Let me just save this file so that we don't lose it. Okay. So generally what happens, you say that A sales plus B sales. So the rule is like, you say parent sales plus subsidiary sales, something like this, because we say consolidation is a process of adding together, which means 100 plus 160, 100 plus 60, this should be 160. Then, let me just make it this plus this, and then this one, then this one, then this one, then this one. So it looks like that makes life very easy. What you do, we call it line by line consolidation. Line by line consolidation means parent revenue plus subsidiary revenue, parent cost of sale plus subsidiary cost of sale, parent admin expenses plus subsidiary admin expenses. So ultimately 35 plus 20 makes you 55. But life would not be so easy because there would be some different situations as well. Let me just start with some rules you should remember. For example, we say that P acquired P acquired 80% of S. 80% of S. This is the first thing. So if P acquired 80% of S, which means P does not own 100% of S, P only owns 80% of S. So what should you do? Should you take 80% of all these numbers? Should you take 80% of all these numbers, like 80% of 60? Because what we are doing here, we are taking entire the $60 here, whereas we know that parent only owns 80%. So can I take 80% of 60, which means 48, and call it 148, and 80% of 25, which is 20, and call it something like 60? So rule answer is that no, you cannot do this, because the rule IFRS standard says you that rule is that consolidate as if you own everything, and then in the end show the extent to what you do not know. Now, I just put my own wordings. Message is clear, message is same. Standard wordings could be slightly different. Consolidate as if you own everything, and then in the end show the extent to what you do not own. Because when I say that P owns 80% of S, basically it owns 80% of S. But I'm saying consolidate as if you own everything, which means consolidate 100%. Consolidate full 100%. And then in the end, show the extent to what you do not own, not know, what you do not own. In the end, we will show what does not belong to us. For example, if I say that if P owns 80% of S, but we are consolidating 100%. So this profit is actually coming from 100%, but 100% does not belong to us because there is a 20% of non-controlling interest. So what we need to do that in the end, show the extent to what you do not own, what does not belong to you, show it in the end. So what we need to do that this profit of 55, here we will say in the one line, profit attributed to the parent, and then we will say profit attributed to the NCI. Now, how much is that? We need to calculate. Let's suppose that this is 40 and this is 50, or maybe this is 45 and this is 10. So you need to split this profit into two parts: what belongs to you and what does not belong to you. But in the beginning, you will consolidate full 100. Okay. So this is what you need to remember. Rule number one. The second thing which might come up, that P acquired S on 1st of July 2020. Now, these financial statements are prepared for 31st of December 2020. Okay. So financial statements are prepared for 31st December 2020, but you acquired you call it mid-year acquisition. We call it mid-year acquisition. You acquired it in the middle of the year. So it means that this is January, this is December. You acquired it in the middle in July. So what happened before does not belong to you. Your concern is only this part, which means 6 months. By the way, so what we need to do, we need to do proportionate consolidation. We call it proportionate consolidation. Proportionate means that now I cannot consolidate 60 because all 60 does not belong to us. We are only partners in the 50% of the time period. So what you need to do, you need to create another S now, which is for July to December. Okay. And usually assume that all income and expenses, they accrue evenly throughout the year. So what I'm going to do, I just will divide with 2, okay? And I'll take all of them with 2. And now I'm going to consolidate these numbers, okay? These numbers we will consolidate, and these numbers we will simply ignore. So this thing you did not do in the balance sheet, because when you acquire a company in the mid-year, the balance sheet values, because balance sheet are assets, assets do not accrue over the year. You only see whatever is the balance sheet on the closing date, and you take it full. But in case of income statement, if there is a mid-year acquisition, and you will especially pay attention in exam, you will see that income statement question comes up. The first thing you need to see is, what is the acquisition? Is it a case of mid-year acquisition? Do I need to consolidate only 6 months or 3 months or full year? Because if you start taking these numbers, all of your answers will be wrong. All of your answers will be wrong. So now, even if you take 30, actually we are taking 30, but still, like we are taking 80%. 30 is actually 100%. 100% for the 6 months, okay? It is 100%. 30 is not 50%. 30 is 50% for the full year. But I'm doing 6 months consolidation. For 6 months consolidation, this 30 is for 100%. I'll consolidate full. I will not call it 160. I'll call it 130. Here I will make 65 plus 12.5, 25 and 5, 15 and 2.5. Okay. So this is the second thing you need to be careful at. I'll delete these numbers now and I'll go back again. This is the second thing you need to take care. The third thing which you will see in income statement would be intra-group sale of inventory, okay? Because that will always happen, intra-group sale of inventory, and as a result, unrealized profit. Now that's very important. Now remember that I just make total of them like this. If there is no intra-group transaction, you actually literally can make a total of these 2 numbers. But there will always be intra-group transactions. Not for the reason that this is exam question, so that's why you have intra-group transaction. In real life, you always have intra-group transactions, because when you are expanding and you are acquiring subsidiaries or different companies, you always have this this idea in your mind that these companies will somehow complement each other. They will benefit each other. For example, this is a construction company and this is a bank. And your construction company will deposit money in the bank, will take loan from the bank, and the bank needs to construct a new branch. They will give order to the construction company. Then you have an insurance company, and the insurance company is going to provide insurance to both of them. So, and the insurance company will put money in the bank, and the construction company will come and make their side. So generally, when you're expanding, you are making acquisitions which are always helpful in your existing business model. So most of the times, these intra-group companies, they will be dealing with each other. Might not be huge, but to some extent, definitely there will be. So intra-group trading will happen. So you need to see the statement now. Let's suppose that I say that during the year, P sold goods to S for USD 10, which had cost P USD 6. Half of the goods are still in inventory of S at the year end. So I just created this one hypothetical scenario for intra-group sales. So who is selling the goods? It is always important to remember when you are saying intra-group sales, you need to establish number one, who is selling, because parent is selling to subsidiary or subsidiary selling to parent. These will be treated differently. They will have a different impact. So first of all, understand who is selling. Number two, find out how much is the unrealized profit. How much is the intra-group profit? I know that intra-group profit was $6. Okay, intra-group profit was $4, because parent purchased these goods for 6 and sold them for 10. So intra-group profit was 4. How much is closing inventory? Closing inventory is 50%. So it means that unrealized profit was $2. Now this is very important to understand. Unrealized profit is $2. Now, if we start now our consolidation, we are ready now to start doing consolidation. So the rule is P sales plus S sales minus intra-group sales. This is how you should write down. If you want, I can just create one more column, and I'll actually take this thing here so that I don't have to delete it. Bring it back here. So I'm going to use numbers 100 plus 60 minus 10. Intra-group sale was 10. So this is going to be my here. And I'll put equals to sign. Do you see this Excel file? Is it shared?
Yes.
So your group sales will be 150. You see the intra-group sales of 10 you have eliminated. Then you come to cost of sales. Cost of sales concept will be the same. I would say P cost of sales plus S cost of sales minus intra-group sales plus PUP. Now, please do not make a mistake. Sometimes students, they think that if this is P sales plus S sales minus intra-group sales, so I should say P cost of sale plus S cost of sale minus intra-group cost of sales. No, not intra-group cost of sales. Intra-group sales, just like you did it above. So here there is one slight exception, that intra-group sales, you will use the same numbers, okay? Intra-group sales. So I would say 40 plus 25, which is P cost of sale plus S cost of sale minus 10. The 10 will remain same on the top and here, plus intra-group plus unrealized profit, which is $2. Okay. Now I'll take it here. I'll put here bracket, and I'll multiply this thing with -1 so that I get a negative answer. It is 57 now. Now, if you see that before it was 40 plus 25, 65, intra-group sales, unrealized profit, 2. And now when I will make it, so you see that your profit individually 60 plus 35 should give 95, but you are getting a number 93. So it means that $2 you have adjusted. That $2, because individually 60 plus 35 makes 95. But on the group, after making this unrealized profit adjustment, you come to 95. Now, you need to make always in sales and cost of sales. I kept a very simple example. But in exam, in reality, your cost of sale might have many different components. Many different components will be adding them there. Sometimes impairment will come there. Extra depreciation will come there because of revaluation stuff and etc. So many things will be there. Admin expenses, generally they are simple. Okay, in admin expenses, you do not do much work because all these entities, they have their separate admin expenses. Admin expenses, usually we don't have intra-group. The same goes with your distribution expenses as well. Mostly intra-group activity is on sales and cost of sales. And then you make a total. Now, if you see that the total now, your total profit comes out to be 53. Before it was 55, like 35 plus 20, 55. Now you see only 53 because $2 in this one, $2 has been eliminated. The double entry is debit group retained earnings, credit group inventory, because we are decreasing inventory here. Now, after this, Because we purchased, P acquired 80% of S. Now we need to find out that NCI, profit attributed to NCI, NCI is 20%. So how much should we give profit to NCI? Can somebody tell me what is NCI's share here now? How much is the NCI share? 20%. So what should I give to NCI? $5, $10, $15, what? Ronnie? Jinesh?
11.2.
Sorry?
11.2.
11.2.
11.
Where is NCI? NCI lies where? Do you think NCI is in P?
No, it's in the group level. 15 to 20%.
NCI is only S within S. So NCI is 20% of S. So it means that I should be giving
What?
NCI we are going to give 20% into 20. That's it. 20% of 20, that goes to NCI, which is $4. That's all. And to here, we'll take 53 minus 4. Group will get 49. Because NCI is not 20% of 53. No, it is 20% only in S, which is $20. Are we clear?
Yes, yes.
Okay. Now that makes sense. Now, see here, what would have happened to NCI? Now, currently it is 4. Imagine that I say intra-group sales. I said here that P sold goods to S because I'm supposing that P is selling goods to S. Okay, this is what we created example. And the unrealized profit actually is somewhere here because P has recorded that profit. Within this 100, this 10 is there. Within this 40, this 6 is there or whatever. So unrealized profit is because of the P. But if we change the situation and we say that not P sold goods, but we say that S sold goods to P, which means that sales are happening here. P is not selling, parent is not selling, but the subsidiary is selling. Now, if a subsidiary is selling, it means that the unrealized profit of $2 is not within P, that actually is within 20. So NCI comes in and says, okay, this is $20, give me my 20% share, give me my $4, I'm going away. I say, no, wait a minute, this is 20, because the subsidiary sold goods. There is unrealized profit of 2, I subtract 2, adjusted profit. The adjusted profit of NCI is only 18. I'm sorry, adjusted profit of subsidiary is only 18. And 18 into 20% I will give you, which makes me 3.6. So then I will not say it 4, I will make it 3.6. And you see, and numbers will change. Because before I distribute profit, I must adjust the profits. Before I distribute profits, I must adjust the profits in subsidiary. I cannot give 20% of 20. So 20, you always need to see, and you will always see, that this profit 20 is never the final profit. We will always have adjustments. Sometimes we have adjustments because of extra depreciation. We need to sometimes see the impact of extra depreciation, impact of impairment, impact of intra-group sales, whatever. There might be some others as well. Goodwill impairment also could be there. Goodwill impairment. So after taking all those numbers, then we will distribute the profits. Are we clear until here?
Yes.
Okay, so these are this was a very simple fund. I just started from scratch. I assume that you people have absolutely no knowledge about consolidation. So I started from zero. Now let's do some questions together, some short questions, and then we move to a longer question.